Hello, everyone. Welcome to the Nasdaq Dorsey Wright podcast for the week ending on September 22nd. My name's Ian. David, good to be back on here with you virtually after we just spent almost a week together out at our symposium last week. So sorry for those of you that were hoping for a podcast last week, but thank you to those that did come out and see us in person at our 2023 symposium out in Vegas. David, did you leave the tables up last week?
I was among probably the very, very few that didn't approach the tables last week. I watched from afar in many ways, but that doesn't mean I wasn't for a lack of a good time either. So we had a great time out there, and it's always a good event. And still, in a way, adjusting coming back to the East Coast because for us it's weird going out there to the West Coast. But I think my sleep schedule is back to normal now. But
Yeah,
we'll see.
it's definitely a little bit of an adjustment, but it's certainly been quite an adjustment coming back into things and market movement over the course of the past few days here. I mean, just kind of diving into some of the movement, David. You saw some, I mean, honestly, what I felt like was expected movement from the Fed with their kind of decision to hold rates yesterday. But as we were kind of talking about in our research call this morning, I mean, they were expected to hold, expected to be hawkish, but they seemed a little bit more uncertain potentially
Hmm.
than many might have been expecting them to be. And that equity markets did not seem to like that very much, right? I mean, we're coming in,
Right.
we're seeing into the close yesterday, as soon as the comments started going on, we saw the Nasdaq down over 1.5% through market movement yesterday. We're seeing the Nasdaq 100 at least down another percent at the time of this recording on
Hmm.
Thursday. So we're recording this podcast Thursday morning. But yeah, it's not at least wasn't a good sign post Fed meeting yesterday.
Not what one would have anticipated in some ways. We're still kind of in this funky, almost like the expected news might be bad news, but it could be good news type of situation. We're not really sure in a lot of ways. But ultimately, the reaction is we've seen to the downside. Like you mentioned, we've seen the Nasdaq Composite break down, or at least now give an initial sell signal. We saw the S&P do that earlier this week in terms of breaking down there, but with today's action coming down to test support there at that 44 or 43.40 and 43.30 level, looking at the chart of the S&P 500. Additionally, we've come in and this week we now see small caps breaking down even further. They're sort of been
Yeah.
a precarious position, but continuing to move lower for small caps.
Yeah, before we dive into the small cap picture, I think it makes a little bit of sense to talk about. I mean, so when looking at the S&P, right, we saw stair step movement higher on that default chart for the S&P 500. We then saw that kind of consolidation right toward that 50-day or 10-week moving average on the midpoint on a trading band, right around the 4,500 to 4,550-ish level consolidation over the course of the latter part of the summer, right? July into the early part of September, just kind of an extended triangle pattern going toward that point. And to your point, we've now broken that first sell signal. I mean, interesting to note that we saw a string of several consecutive buy signals, and this is still the first sell signal after multiple consecutive buy signals, still in a positive trend. Just one sell signal down is not the end of the world. But there's some notable support, like you mentioned there, that 43.40. And after that, you're looking down towards the trend line at your next support level.
Right. And it's honestly somewhat we honestly in a way got lulled with the continuous buy signals in a way because we saw so many, there was a level of confidence that, hopefully they continue. But ultimately, we've only ever seen the S&P get to 8 or more buy signals on consecutive buy signals,
Right.
that is, on 2 prior occasions. So even
Right.
seeing 7 is rare. And we often see a lot more action on the chart than that type of just continuous stair stepping action. So really seeing this consolidation wasn't too surprising, even seeing this initial sell signal. Obviously, our hope here is that really we hold this support kind of in the lower 4,300 level and we're able to rebound off that. Ultimately, though, it is kind of interesting that we're talking about the trend line and that sits here at 4180, but really that puts us back in position where the S&P was back in May. So it's not like we're
Right.
revisiting 2022 lows or anything like that. We're just kind of consolidating. Would that be very oversold? Yes. Seeing May's prices, it would be very oversold from here. But kind of an interesting point in time reference after we've seen consecutive buy signals, not much negative action. And now when we are, it's sort of trying to figure out where we might find our footing. And our footing is a little closer than maybe we would have thought in a way.
Right.
So I
Right.
do think that's interesting.
Right. I mean, we're still up 14% year to date, right? I mean, it's still a
Right.
pretty solid move on a year to date perspective for the S&P. So it might be expected, as we've had some bits in the report. The back half of September is typically not a great period for the broader domestic equity space, right? And so we're seeing that kind of play out over the course of the last week or so here. David, I know you touched on small caps briefly there. We've seen the S&P's up 14% year to date, 14% plus year to date. See how things shake out with the movement this afternoon. Not the same can be said for most broad small cap areas. I mean, we're looking at some broad areas relatively flat. I know you were looking at IDW broke some pretty notable support over the past week there.
Yeah, we saw it move below that 180 level yesterday, and even with today's action, seeing it fall further down to 178. That move below 180 actually not only breaks a quadruple bottom for IWM, the Russell 2000 ETF, but it moves it back into a negative trend after only a brief trip into a positive trend there from June, in which we saw it kind of flip back into a positive trend. So still seeing a lot of sideways action. Also, still interesting that looking at the chart here, just a brief look up, that when we saw that rally in July, we got almost up to that $2,000 level, and it still is acting as a very significant level of overhead resistance and has been in place since really August of last year. So we're over 12 months now that we've had that $2,000 level for the Russell 2000 be, even looking at IWM and the index itself, be a significant level of resistance and a barrier we've yet to really be able to cross above for small caps at the moment.
Yeah, I mean, you look at that, the default chart for IWM, I think, shows a pretty descriptive or depictive picture.
Mm-hmm.
Don't know if that's a repetitive word used there, but you're looking at that. I mean, really, it reached 210 on that default chart in March of this year. Ultimately fell, or March of last year, excuse me, March of 2022. Ultimately fell down to that 164 threshold by June of 2022. And it's
Mm-hmm.
just bounced back and forth from one to the other really since that. It just moved straight sideways since that time. You can draw, I mean, it's not really difficult to draw those real definitive kind of just overhead
No,
resistance from that
not at all.
198 to 210 level. And then you got that strong support down at 164 that was last tested in October of last year. And then we see some more notable support around that 168 to 170 threshold more recently over the past 6 to 8 months or so. But when you're looking here at that trend line break, we've seen the trend line flip back and forth several times over the last 18 months. So I think that's another important thing to note when you're seeing this, the default chart just move up and down that really defined wide but defined trading range. That's caused a lot of trend shifts. So the trend line violation here is notable, but we're looking toward still some support levels that are going to be offered with the movement that we've seen over the past few weeks. I mean, you got support at 174, support at 170, support at 168, and then you're looking down at that 164 point moving forward. So just because it breaks trend doesn't mean we don't have near-term support, but not a great sign for the small cap space that has continued to lag the broader, more large cap focus domestic equity space over the past few months here.
Right. And it was one thing that I think we talked about yesterday on our meeting, was looking at that Russell 2000 right now, even just against cash. You've seen RUT reverse down against our money market proxy, MNY MKT, on a 3.25% scale. And, it had been in X's for really only a couple of months, but ultimately it is something that you've also seen that chart waffling back and forth and really showing improvement out of small caps and deterioration to the extent of saying, okay, cash is relatively better here in the near term. Long term, RUT still favored, but like we see on the chart here, you're getting much of the same story from the relative perspective, even against cash, because you've seen sideways action for it for really now working on the past year, even 18 months plus. So it's kind of an interesting position for small caps to be in, especially when we have such strong large cap leadership right now that, at least for the moment, appears to be maintaining that leadership baton, or that high podium position, if you will.
Right. And I mean, we see that in shifting the gears a little bit. We see that large cap leadership maintained in other rankings that we have on the platform, like the asset class group scores page. I mean, large cap growth, right? The kind
Mhm.
of bellwether area, certainly through the first 7 to 8 months of the year, still ranks in the top 10, one of the only groups in the blue sky zone above an average score north of 4.0. Still ranks above large cap value, although they've moved closer. But there's been some other interesting development. I think, first thing to note, there's a big gap between the large cap
Right.
groups and the other mid cap and small cap areas. But in those mid cap and small cap areas, we're seeing some more interesting developments on the value side more recently versus the growth camp.
Well, right now, if you look at that US styles view, you actually see a position where mid cap value sits above mid cap growth. Same thing with when you look at the small cap value and small cap growth. You're seeing small cap value just slightly edging out growth there. But this week, we've actually seen the all growth and all value funds swap places. They actually now with all value ranking above or scoring above all cap growth right now. And this is the first time really since March that we've seen all cap value maintain a pretty significant score, at least for more than a day or two. Right now, this action began on Monday, so we're still working on that potential of it extending a little more. At the moment, it's still sort of short term. They're still jockeying pretty close for position, so wouldn't be surprised to even see them flip back. But if that score continued, that spread between all value and all growth continues to grow, then that's going to be far more significant. So keeping an eye on those two broad groups is going to be pretty notable over the next couple of weeks as we move towards the end of September and right on into October.
Yeah, and in looking at going back to the large cap space too, I mean, we've seen all value overtake all growth. Like you said, they're still pretty close. The movement
Mhm.
on the large cap growth versus large cap value, I think, is kind of notable because you've really just seen large cap growth move sideways in score since, I mean, almost March of this year. I mean, it's maintained a favorable score north of that 4.0 threshold,
Right.
but it hasn't really done much. It's just moved sideways since. Meanwhile, since June, late May into June, you've seen that all value just continue to kind of stair step and move higher. So when these areas are moving close to each other, I mean, it's been a few times over the course of the past couple of years that we've seen improvement from value go up and at least touch or move close to that growth camp. I mean, it'll be pretty interesting to see how that development plays out as we look toward the fall.
Right. And really, in a month, especially moving towards October, that many often have said that they have a love hate relationship with. It's either really great or it's really bad, one or the other. At least history would provide us with that thought. So, moving into October, the fact that we're seeing kind of an uptick in value, we're kind of in this position with this week's reaction to the Fed obviously kind of leaves you with a little bit of wariness in a way of moving towards the end of the year, but in some fashion looking at group scores right now there's not really much of an argument going against have both growth and value, have your combinations there and really spread, in this case spread your net wide, rather than being so focused because you're seeing strength really out of both.
Right.
um, so
Right.
it's kind of interesting with us moving towards the back at the end of the year, really, and then towards that last quarter of the year, and with October just right around the corner.
Yeah, and I think that's an interesting point to mention. I mean, you're seeing strength or certainly maybe a little bit of resiliency from both, right? I mean,
Hmm.
we've seen some near-term weakness on major core domestic equity representatives like the S&P. We've seen a little bit more weakness on the small cap space. But you're still seeing the core equity market, that US equity core percent rank that we have on the group scores page,
Hmm.
is still up at almost 98%. I mean, it's just there's not much beating the core broad market. Like you said, broad being the key word there, right? And
Right.
so when you're seeing that hang around, I mean, typically we don't see it hang around at this high of a level for that long, right?
Hmm.
So it might be natural to expect a little bit of a back off if we see some of these near-term weakness create some pullbacks for that broader kind of core representative. At the end of the day, that's probably not the end of the world to see some other areas that
Right.
could potentially come up into the favorable areas on that group scores page. And not to say that we're going to be seeing another big shifting of the guard from an asset class perspective, but one thing we've certainly seen recently is a resurgence in some of the areas of improvement that we saw in the first half of last year, and mainly on the commodity space, right?
Right.
And we've seen some weakness from some other areas on the international side. And in playing around with how that movement relates to last year's movement, it'd be hard not to look toward the US dollar, which has just continued to move straight up toward its kind of current resistance point, at least on that default chart there for DX/Y.
Yeah, and the fact that we're seeing that happen, and it's almost it's somewhat similar to last year. We're seeing this rally out of crude, rally out of the dollar, typically not two that you would think are often correlated, but the past 2 years there's been a much higher correlation between the two. And it's interesting to see now that both are coming up to levels of resistance. Yes, we've seen the dollar kind of add another potential X here today, but we're also kind of in a position with crude where it's cleared some pretty significant resistance as well in recent months. So maybe a little bit more of overhead kind of headwind, if you will, for the dollar. There's still a little more in the offing there, but still, I mean, depending on where we may see rates go, that's been a big part of the conversation is, do we continue? Does that provide a tailwind for the dollar? Do we see a higher dollar towards the end of the year here? So all of these things are coming at a very interesting point in time for us as investors, for sure.
Yeah, I mean, it certainly is. And you mentioned there, I mean, we don't typically see that kind of correlation between crude and the dollar. I mean, when we're looking at these charts, that's part of the beauty of why I love what we do, and because we're just looking at the price movement, right? We can talk about why it might be happening, but at the end of the day, it's happening. We're seeing the dollar
Right.
move higher. We're seeing the dollar touching that 105 point. We're seeing that notable kind of trend line test that we're seeing around that 105.50 level. We'll see if it continues to kind of climb. There's notable resistance from February and December, January timeframe from last year. But it's just moved straight higher in that column of X's. And in the day, that movement is kind of taking place. And if it's able to show some further follow through, I mean, certainly provides for some headwinds there on the international front. We'll see how that plays out in the commodities front moving forward. But there's no shortage of price movement that we're going to be able to continue to keep track of as we move into that love-hate relationship with October, David.
Yeah, and it's not going to get any better either, because we're in a position where we continue to watch rates rise at the moment, at least today. So,
Right.
kind of an interesting position as well. So, with that Fed meeting, we did see the basically, like you said earlier, there was an announcement that obviously we weren't going to see rates risen this month, but it wasn't left off the table, and there wasn't as much confidence conveyed by many of the speakers, especially Fed Chairman Powell, in terms of levels of confidence in the economic data, or sort of a path really that they see forward. So is interesting with that reaction today. We're seeing, the 2-year and 10-year and really almost many of the yield charts break out, or not necessarily break out, but move to new levels we've not seen them in decades. So, it's pretty surprising to take a look right now, at least at some of those charts, which feels like I've been looking at those charts a lot more in the past 2 years than I did prior. Has definitely become a part of the consistent daily routine for sure.
Yeah, it's definitely a lot more consistent recently. And I mean, we've seen some pretty consistent movement for some of them higher too. I mean, it's seen some sharp reactions and sharp or new thresholds that have been breached with some of the movement of the past day or so. But it's not like this was a turnaround for something like TNX, right? I mean,
No.
we're seeing it touch that 44.50 point with movement today out there on the default chart for the 10-year yield. It's now given 1, 2, 3, 4, 5 consecutive buy signals on that default chart, which is the most consecutive buy signal strength we've seen for TNX in this most recent ascent, going back to the end of 2020 was the last time we got 5 consecutive buys from there. So we're seeing some sharp movement. I mean, we've seen, David, like you touched on earlier, I think that is, who knows if news is good or bad news at this point with some of the different reactions that we're seeing. But we had seen in prior kind of post-Fed hangover periods of sharp movements that might change over the next week. So I think that not to say that it's going to, but I think that's something to at least kind of keep an eye out there for. It'll be interesting to see how things might shake out as all the reactions and kind of movements processed over the course of the next week or so.
Absolutely. I mean, like you said, it seemed almost for the past 12 months, maybe even longer, that this type of week has been really where we've seen the notable movements, volatility uptick, chart movements, chart breakdowns, breakouts, whatever it may be. This is when the reactions have been occurring, and a lot of it is centered around sort of the Fed's policy. So don't know that that's going to change anytime soon, but it is worth noting, like you said, that a week out, typically we've sort of seen some things kind of not completely quiet down, but begin to quiet down and
Right. At least
settle,
shake
if you
out.
will.
Kind of. Yeah.
Yeah, and at least kind of settle, and once the dust settles, in many cases, that's when we begin to kind of take stock of what has occurred. I think right now, we've both talked about so much today on the podcast. This week has been full of things that are going on. We're honestly towards the end of the week. It's let's get on through next week, see what the reaction might be, and then at that point, I think you may have some conversations that may be in the offing, but with that time, it gives you time to think about it as well.
Yeah. And I think it'll be good. We could keep talking about interest rates probably for another podcast episode. Maybe we'll look at that next week.
An entire one. Yeah. Could be a
Maybe
special
series.
edition one.
Right.
Mm-hmm.
Right. But with that, I mean, like you said, I think we've hit on a lot of content today, thrown some charts. For those that are just listening, we do want to make sure to note we do have the podcast available on YouTube on a weekly basis. So we'll be sure to put some of these charts up there and highlight some of the points that we we're talking at. But with that, David, I think we can go ahead and wrap it up here. So thanks for hopping on this week, David. Thanks for tuning in, everybody, with the second to last podcast here in September, and we look forward to talking to you all again next week.